Now the corporate P&L. This is the one you're actually buying a share of if you buy stock, right? So move over 16% because Daddy HQ is pulling down a 47% adjusted EBITDA margin. So how is that possible on cold cuts? Well, corporate skipped the lease, it skipped the labor, the roast beef, and the build out, and it took its 11.5% that we talked about off the top. Both sides are making money though. Off the same register, they do have wildly different cost structures, but they're still pumped about it, right? Which is the trick to successful franchising. Nobody feels like they're being robbed here. Let's go over the Blackstone math. And by the way, this TAM chart that they put in, I know there's no y-axis. There are no axes, but this is an area chart crime of mass proportion. Someone has to call the police. The most misleading number in this whole filing is the 55 million of net income. And it's misleading for a super boring reason. It's because Blackstone financed the holy hell out of this, and it purposefully creates a whack of interest payments and non-cash expenses. So the first thing that I do with a sponsor-owned S1 is hunt down the D&A line, depreciation and amortization, because purchase accounting always leaves a mark, in this case, a crater. The accountants, artists, they revalued what Blackstone bought and wrote it onto the books at fair value, which is how a $5.7 billion trade name lands on an $8.2 billion balance sheet that holds just 13 million in physical assets. The trade name gets amortized, and so does the franchise agreement intangible sitting next to it. And so together, they pushed D&A to 96 million in the first year under Blackstone. So they created this $96 million charge, up from about 10 million the year before. So keep in mind that none of it is cash, but it's all very real on the income statement. The debt is the other half of the equation. Blackstone dropped 2.1 billion in long-term liabilities onto the company through what's called a whole business securitization. What they did was they pledged the brand, the trademarks, the franchise agreements, and the royalty streams into a vehicle, and they sold notes against them at rates between 2.5% and 5.6%. That's actually pretty good. That registers at 90 million of net interest in year one, and the Financial Times counted roughly 500 million of dividends were paid out of that debt before the S1 ever went public, which tells you what that borrowing was for. Here's the full walk under Blackstone. So you start at net income of 59 million, but then you add back the net interest of 90, you add back D&A, mostly the new trade name and franchise book, another 96 million. So their plain old EBITDA is around 247 million. Then you add back area director buyouts, which we're going to get to in a second. That's 52 million. Stock-based comp of 8 million, IPO cost of 7 million, corporate transition of 13 million, you get to an adjusted EBITDA of 327 million. When you add the interest and the amortization alone, you've bridged almost the entire gap. That's how you get to the 327 million or 186 million of interest and non-cash amortization. These chunks are derived from the buyout structure and not actually indicative of how Jersey Mike's makes these subs. Net, if you strip the deal financing off the top and the store level business is 47% margins, the 55 million of net income is just what's left after the LBO eats first. All right, so let's talk about the 2% their CEO is clawing back. This is pretty fascinating. So perhaps the smartest move in this filing is the one that makes the current year look worse. So bear with me here. For most of its life, Jersey Mike's did not sell franchises through corporate. It sold them through area directors or independent operators who bought the development rights to region and then recruited and supported the franchisees inside it, collecting roughly 2% of gross sales on every store in their territory in return, forever. It's how Cancro grew the system without building a corporate franchising arm, and it meant a slice of the royalty stream was peeled off to middlemen before it ever reached headquarters. It did serve its purpose in getting to scale, but now the CEO is buying that annuity stream back. The company has been paying each area director a lump sum to tear up the contract. Then they pull the function in-house and they turn a permanent 2% haircut into a one-time cash cost. Pretty smart. That shows up as the 52 million labeled area director buybacks that's sitting in that adjusted EBITDA, with more coming as they work through the rest of the territories. So just know that non-recurring is kind of recurring, since the buyouts are going to keep landing in the add backs for years while they consolidate the model. Some potential red flags. It's an Up-C structure. What the hell does that mean? It means you and Blackstone do not own the same thing. So Jersey Mike's is going public through a structure called an umbrella partnership, C Corp. Here's what that means for you in practice. When you buy the stock, you're buying Class A shares in a holding company that sits on top. That holding company's only real asset is a stake in the business underneath it, where Blackstone and the insiders hold their ownership directly. So you own a piece of the parent, they own a piece of the actual sandwich operation. The two aren't really the same piece, because Blackstone gets the tax perks of holding the business at the lower level and gets to convert into your shares on its own schedule, which means you never quite know when a wave of insider stock is about to land on top of you. And generally speaking, when a company hands the public the top 4 shares and keeps the operating company for the sponsor, that's a structure built for the seller's benefit, not yours. And they also have this chart, which you would need approximately 20 years of tax experience and a degree in Egyptian calligraphy to make heads or tails of. Number 2, the company owes its old owners a check for its own tax savings. What? This is called a tax receivable agreement. And I was today years old when I learned what a tax receivable agreement was. It's a cash bill the business agrees to carry. The short version here, the company gets a tax break, then pays about 85% of that break in cash back to Blackstone, and the other people who sold you the stock. You as a shareholder only get to keep 15% of the benefit. It's real money leaving the company you own, going to the people who just cashed out for years after they're gone. And they don't even have to hold the stock to keep collecting. They could technically sell it. Number 3, this is what you would call a controlled company, so the governance guardrails are pretty optional. Blackstone will hold a majority of the combined voting power after the offering, which lets Jersey Mike's claim the controlled company exemption under New York Stock Exchange rules, where they're going to list. In plain terms, it does not need a majority independent board, and it can skip independent compensation and nominating committees. Number 4, there are no dividends coming to you, but the sponsor may take a nibble. The company has no current plan to pay dividends on the Class A stock that people will buy into, but the proceeds from this offering will go towards repaying the securitization debt and funding a distribution to the pre-IPO owners. And per the Financial Times, like we said, roughly $500 million was already dividend out through those securitizations before this S1 was public. Number 5, the profit number they want you to use leans on a big trust us. The $166 million in charitable donations that Jersey Mike's rightly puts on its own cover as a badge of honor, pretty cool, gets added back to make the profit line look bigger for the IPO. This giving was done under the previous founder. So the company adds back all this good stuff, and their logic is that this was a founder's discretionary generosity, which won't happen once Blackstone runs the place, which I guess is fair. It also means the founder era profits are almost useless in comparison, and you're trusting the company on what's truly one time, including that $52 million area director buyout that they'll keep paying for years. March is about to get a lot more profitable for Blackstone. Number 6, the debt is wicked cheap now, and it might not be later. So the $2.1 billion sits in a whole business securitization at blended rates between 2.5% and 5.6%, which is a lot better than my mortgage rate. But then you read the maturity structure. So the notes carry anticipated repayment dates starting in 2029 and legal final maturities out to 2052, my goodness, and beyond, which means the company is expected to refinance these tranches at whatever rates exist at the end of the decade. A brand collateralized bond issued in 2021 at 2.5% probably does not get refinanced at 2.5% if I was a betting man in 2029. This is not financial advice. I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations. Woo! Everything a scaling company needs. They've got 5.0 star, 50, wow, 50 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me.